Hi, this is CH. This video is part of a series of videos titled My ABCs or Absolutely Biased Comments to share how an individual investor like you and I can try to find out more about an investment fund from public sources and do some basic research or simple due diligence before deciding to buy the fund or walk away. Do explore the other funds covered in this series and subscribe to the channel if you find this video useful. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. The information shown and mentioned in this video is accurate as of the date stated here. In this video, I will be talking about the PIMCO Capital Securities Fund. This video is done as a follow-up request from a viewer's comment in my previous video covering the Allianz US High Yield Fund. If you would like me to cover any funds or ETFs, do drop me a comment in any of my videos, and I'll be happy to work on it as long as I can find enough information on the product. The Pacific Investment Management Company, or better known as PIMCO, was founded in 1971 and has over the years established itself as a leading global asset management firm in active fixed income investing with deep expertise across public and private markets. PIMCO today manages over $2 trillion worth of assets from investors of all segments, supported by over 3,000 employees based in 24 office locations globally. PIMCO offers a wide variety of fixed income managed products, with credit-focused and income-focused strategies being its specialty. The solutions are offered to clients globally across the full spectrum, from central banks and sovereign wealth, to pension and endowment, to family offices, to private and retail investors. PIMCO puts quite a lot of effort into understanding global macroeconomic and geopolitical changes in order to ensure their funds steer toward the right directions. This is helped by their Global Advisory Board, formed by ex-central bankers and ex-key government officials who can help guide the firm in this aspect. The Global Advisory Board members are updated periodically. Ng Kok Song, ex-CIO of Singapore's GIC and presidential candidate in 2023, used to be in this board as well. PIMCO was acquired by Allianz SE in the year 2000, but runs as an autonomous subsidiary. Therefore, its product offerings are independent from other asset management businesses of Allianz. The PIMCO Capital Securities Fund is a sub-fund under the PIMCO Fund's Global Investors Series plc or PIMCO GIS fund family. PIMCO GIS is set up as an Irish ICVC company structure and is UCITS compliant. The fund is registered as a MAS recognized scheme, which means it is suitable for retail investors. I am surprised that this is not a MAS restricted scheme, because I think that the fund strategy and underlying investments are more appropriate for accredited or sophisticated investors. The PIMCO Capital Securities Fund has 4 co-managers as per stated in the fund webpage and fact sheet. The manager bios are not directly accessible from the fund webpage, but they can be found by Googling the names accordingly. Philip looks to be the lead manager of the fund as he is the head of the credit research team in Europe and also the lead analyst for global financial institutions. Matthew also seems to be a key member as he is a credit analyst focusing on systematically important financial institutions or SIFI in US and Europe, which is the main coverage for this fund. Both of them have worked in PIMCO for about 20 years. So they are definitely senior and experienced professionals managing the fund. Michael and Eusta have slightly shorter, but nevertheless still decently long industry experience of 19 and 15 years respectively. They bring about a different background as credit traders to the team. Morningstar information shows that Philip has managed the fund since its inception in 2013. Michael and Matthew were added in late 2017. Strangely, there is no mention of Eusta here. Nevertheless, the manager team looks decently stable, which is good for the consistency of the fund strategy. The PIMCO Capital Securities Fund provides a fund description instead of an investment objective in the fund webpage and fact sheet that states it is an actively managed global portfolio that invests primarily in Tier 1, Tier 2, and contingent convertible or CoCo bonds. These are financial terminologies that some retail investors may not understand, which is why I am surprised that this fund gets a MAS recognized scheme instead of restricted scheme. Let's spend a few minutes to understand what these investments are. Here is a simplified capital structure illustration that I obtained from VanEck's website. The capital structure essentially refers to the different sources of capital for a company, ranging from the different types of debt or bonds down to equity shares. The capital structure determines who is safer on the list, i.e., who gets more recovery when a company becomes insolvent. For example, a senior bondholder has a higher likelihood to recover more monies compared to an equity shareholder who will typically get nothing back if a company goes bankrupt. As such, the amount of risk and return also typically follows the capital structure, with equity shareholders typically having the highest return potential, but also gets significantly more volatility and risk than the others. Non-financial companies will typically issue only senior debt or senior bonds as well as common equity shares. You can see even senior debt is further split into different layers in the capital structure, so be mindful when you invest in direct bonds as well. Financial companies such as banks and insurers also issue hybrid bonds because they have additional regulatory requirements. By calling them hybrids and with them sitting in between the normal bonds and equities, you know that they are not to be treated the same as normal bonds. This is exactly what the PIMCO Capital Securities Fund is primarily investing in. There are many financial education websites providing details, so I will not elaborate here. This is an extract from Investopedia, where you can see that hybrid bonds are basically used as emergency capital, whereby it is possible for these hybrid bonds to lose part or all of their value when they are used by the company to absorb losses during critical situations. Hybrid bonds are further split into Tier 2 and additional Tier 1 or AT1 according to regulatory requirements. The handling of AT1 capital is also different across regions. In the US, companies issue preferred stocks to cover AT1 capital requirements. In Europe, companies issue contingent convertible or CoCo bonds. CoCo bonds are named this way because they automatically get triggered when the company's capital fall below a predetermined threshold, where then the CoCo bond either gets converted into common equity, or gets a temporary write-down on its value, or gets a permanent write-down on its value. Here is a summary table from PIMCO comparing some of the key characteristics across the capital structure and also showing the differences between US preferred and Europe AT1s. Interestingly, while these hybrid bonds have the additional and differentiated risk compared to normal bonds, these risks do not translate into low credit ratings. You can see in this same table that Tier 2 and US preferreds typically still has BBB investment grade credit rating, while Europe AT1 can have a mix of BBB investment grade rating to BB non-investment grade rating. Investors therefore have to be careful not to confuse these bonds with normal investment grade bonds. I personally do not agree with this, and I would treat hybrids like high-yield bonds because of the additional risk involved. Some investors may assume that these are generally safe investments because banks don't normally get into trouble easily. But extreme events do happen, and they can happen very quickly. The most notorious event relating to hybrids in recent years is the collapse of Credit Suisse in 2023 that led to a full permanent write-down on the value of its CoCo bonds. While this was controversial and investors are still trying to take legal actions, it does show that hybrids do have significant risks embedded within them. So, with these explanations, hopefully you have a better understanding what this fund is investing into. And I again suggest that you treat this more like a high-yield bond fund investment in consideration of the risks involved. Let's go through the fund prospectus next to understand the investment objective and strategy better. The prospectus states that the investment objective of the fund is to seek maximum total return while at the same time have capital preservation. This is done with a focused exposure of at least 80% into attractively priced capital securities that are the hybrids mentioned earlier. This follows with some details on the investment process. which is a combination of bottom-up and top-down processes that is split into three screening processes. The first screen is a top-down view of the economy and global financial markets, presumably to identify country biases and potential risks in the markets. The second screen is the bottom-up research and analysis of the issuer's balance sheets and company earnings power, together with interviews and conversations with senior management from the issuers to better understand the financial stability and risk. The third screen is valuation, which should simply be to compare and prioritize the most attractively priced bonds. The fund uses the Secured Overnight Financing Rate or SOFR as its benchmark for performance comparison purposes only. SOFR is typically used as a guideline for short-term deposit rates and is usually similar to 1 to 3 month US Treasury yield. So this is a really low bar benchmark for bond funds to try outperform, and is quite different from the performance behavior of hybrid bonds. SOFR is currently around 4.1%, although it should get lower if US continues with its rate cuts in the coming months. The fund has no restrictions on credit rating and can potentially be fully invested in high-yield rated bonds. There is a maximum 7.5% limit per corporate issuer to prevent the fund from being overly concentrated in a single financial company. While most hybrid bonds have perpetual tenors, they typically have a call date after 5 to 10 years. Therefore, the average portfolio duration is expected to normally be in a range of 3 to 7 years. The fund can also hold non-US dollar currency positions, as Europe Cocoa bonds is a big component of the hybrid market and do come in non-US dollar currencies such as Euro and Sterling. The managers will then decide whether to hedge the currency exposures depending on their macro view on the currencies. The fund can also invest maximum 10% in common stocks, maximum 10% in other funds, maximum 10% in illiquid loans that constitute money market instruments, and also use derivatives for both hedging and investment purposes. These are pretty common restrictions for most mutual funds. Let's look at the fund portfolio next. The PIMCO Capital Securities Fund was incepted in 2013 and currently has an AUM of over 5.5 billion US dollars. This is a very decent size for a bond fund that specializes in hybrids. The base currency is US dollars and the benchmark is SOFR as previously mentioned. The portfolio currently has about 86% invested in capital securities, or bonds and hybrids issued by financial companies. Banks naturally take the bulk of the allocation, given they issue out hybrids way more than insurance companies. From capital structure perspective, we can see that European AT1s or COCOs take the main allocation of about 61%. In contrast, US preferreds are less than 5%. Tier 2s are not significant as well, with only about 8%. The hybrid risks are kind of balanced off with US Treasuries and derivatives such as duration hedging instruments. This is reflected in the high allocations to US as a region and government bonds in the sector allocation. This risk balancing approach is quite common to see in PIMCO's funds. Given the way the portfolio is constructed, it is inevitable to see the top 10 holdings are typically European AT1s or COCOs. The portfolio currently has an effective duration of 4.22 years, which is in line with most bond funds in the market currently, as fund managers are observing US rate cut actions in the coming months before making more significant adjustments to portfolio duration. We can also see that the portfolio has a very high yield to maturity of 7.38%. Hybrid bonds tend to have very high coupons to attract investors and sometimes offer even higher yields than typical high-yield bonds. While the numbers look attractive, investors should be well aware that nothing comes for free, and the high coupon yield commensurates with the potential risks involved, just like high-yield bonds. We will revisit the distribution yield numbers later. The portfolio currently has an average credit rating of A-. The fund doesn't provide credit rating breakdown, but we can get some details from Morningstar. We can see here that the corporate bond exposures is about half investment grade, mainly in triple Bs, and half high yield, mainly in double Bs. This is however boosted up by the AA government bond exposures, and therefore the resulting average rating is decently high at A-. The PIMCO Capital Securities Fund has a few share classes, but not that extensive in terms of currency classes compared to some of the other PIMCO's products. Both E and M retail refer to retail share classes. I can't find any meaningful differences between the two, except that the E distribution class has a quarterly payout frequency, while M retail distribution class has a monthly payout frequency for this fund. Accumulation class is available for US dollars but not for Sing dollars. Income refers to distribution classes, and Income 2 refers to distribution classes that have an enhanced or higher payout yield, generally achieved by using capital to top up to the payout. We will go through the distribution yields in a while. Non-US dollar share classes are currency hedged, except for Hong Kong dollars, given it is currently range-pegged to US dollars. Most of the share classes were created shortly after fund inception in 2013. PIMCO usually provides a total expense ratio or TER instead of management fees and other expenses. The TER of both the E and M retail classes is 1.69% per annum. Up to 60% of this fee may be paid by PIMCO to distributors as trailer fees. Distributors are allowed to charge up to 5% subscription fee for these share classes, although I think 1% or less for bond funds would be more appropriate. Given the popularity of PIMCO's products, it is sometimes possible for retail investors to access a lower fee share class via some distributors. The difference between the TER translates directly into the performance of the fund. For example, if you are able to access the institutional share class that has a TER of 0.79%, that means your investment in the fund would be about 0.9% better every year than the E or M retail share class. Therefore, it is in your benefit to find distributors that can provide lower fee share classes. The PIMCO Capital Securities Fund provides the annualized distribution yield on the respective share class web pages. Currently, the E-US dollar class has a payout yield of 4.36% per annum, while the M retail US dollars and Sing dollars hedge classes have a payout yield of around 6.1% per annum. Given the fee structures are the same, the difference of around 1.74% in the payout yield between the E and M retail classes translate directly to the difference in the NAV growth, meaning the NAV of the E class will have a 1.74% higher performance than the M retail class, because that same amount has been used by M retail class to pay out as additional distributions. Also, given the payout yield of the M retail US dollar and Sing dollar hedge classes are the same, this means that the currency hedging cost of the Sing dollar hedge class is factored into the NAV. Let's use Morningstar charts to compare the behavior of the three share classes. Here is the 5-year chart of the E-US dollar class total return versus NAV movements. We can see there is some effort to grow the NAV over time. So even with the market correction in 2022, the NAV has managed to recover to a plus 1.8% in this 5-year period. Total return is plus 22.4%, which translates to the 4+% per annum payout yield. Here is the M retail US dollar class that has a higher 6% payout yield, which clearly translates to lower NAV growth, where in this case the NAV is still at minus 6.3% in the same 5-year period. Now bear in mind the total return is the same, as this is exactly the same fund portfolio. So it is a choice between getting more payout versus keeping more capital in the fund for future growth. Here is the M retail Sing dollar hedge share class, where there is a currency hedging cost that impacts the overall returns, that is around 6% lower than the US dollar class for the 5-year period, meaning the currency hedging cost on average has been around 1.2% per annum. Since the distribution payout yield is the same as the US dollar class, this means the NAV growth is reduced further by the currency hedging cost, which in this case is minus 10.9% in the same 5-year period. The PIMCO Capital Securities Fund fact sheet has performance data versus benchmark, with both calendar year and various time periods, so it is pretty comprehensive. The benchmark is a SOFR index, therefore it is a smooth line with nearly no volatility and no negative returns. As such, the fund is expected to outperform the benchmark decently, which is shown in the returns of the long-term time periods. The higher returns come hand in hand with higher volatility, where we can see the calendar year returns exhibit a big range from minus 12.3% in 2022 to plus 16.4% in 2019. Given this is a bond fund, it is also subject to the normal market events that impact the bond markets. Let's run some comparisons using Morningstar charts next. Here is the performance chart of the E-US dollar class since inception. I am using a Mundi Cash US dollar fund as a money market proxy for SOFR. Adding in the global government bond, global investment grade corporate bond, and global high yield bond UCITS ETFs from iShares, we can see that the PIMCO fund has outperformed all of them in this time period. Reducing the time period to 5 years, we can see better correlations in some of these products. I have also added the Invesco AT1 ETF and Invesco Preferred ETF to cover the Europe and US hybrid markets respectively. We can see quite clearly in this chart that the PIMCO fund is performing very similar to the iShares Global High Yield Corporate Bond ETF, which is why I mentioned earlier that investors should treat this fund like high yield bond investments. We can also see that there is quite a big difference in the performance between Invesco AT1 ETF and Invesco Preferred ETF, which is why the PIMCO fund has substantial allocations into the better performing European AT1s and very little into the US preferreds. Also worth noting is the collapse of Credit Suisse and the controversial handling of its AT1 bonds in 2023, which led to a big correction that took about a year to recover. While there is a low likelihood for such a scenario to repeat again, it is not impossible, and investors should bear in mind that the collapse of a significant financial institution can potentially cause a big ripple in the hybrid market, as this market is concentrated within the financial sector. For peer comparisons, two other popular funds available in the Singapore market that play the hybrid markets are the Algebris Financial Credit Fund and Principal Preferred Securities Fund. Algebris has a higher and more concentrated exposure to European AT1s that results in a higher return over time. Principal, on the other hand, focuses more on US preferreds and interestingly has a similar performance as PIMCO in the long run. Interestingly, both Algebris and Principal funds are MAS restricted schemes. So what can the PIMCO Capital Securities Fund do in an investments portfolio? The nature of the fund strategy makes it more a tactical play or satellite allocation in the overall portfolio. If you already have a global diversified bond fund for long-term core positioning, such as PIMCO GIS Income Fund or other similar products, and would like to add on some high-yield bond exposures to try improve overall returns or to get higher distribution yields, the PIMCO Capital Securities Fund may serve as a punchier replacement than high-yield bond funds. As seen in this chart, it can deliver higher returns than PIMCO's own global high-yield bond fund, although it comes with higher volatility as well. With that, let's summarize our findings. PIMCO holds a high reputation as a global leading active manager in fixed income solutions. There is no doubt in the amount of resources behind each bond fund under the PIMCO branding. The fund manager team has stayed consistent for the past 8 years, showing stability in the team, which is good for the fund. The investment strategy information is quite comprehensive, although more can be provided for the investment process. The nature of capital securities, in particular hybrid bonds, are rather complex. It is therefore strange that the fund is able to get registered as a MAS recognized scheme for retail investors. Most other funds in the same category appears to be registered as MAS restricted scheme instead. While the fund has a pretty flexible investment mandate, The fund currently runs a barbell portfolio of mainly European AT1s, balanced off with US government bonds, which is a common risk management approach for PIMCO's products. The distribution yields of the M retail share classes seems to be a bit too high to be sustainable, as the NAV of these share classes have no meaningful growth over time. The performance track record shows the fund is comparable to high-yield bond exposures, and can come with slightly higher returns with slightly higher volatility. This suggests the fund can potentially be a punchier replacement for high-yield bond allocation in an investor's portfolio. The fund is, however, not the best performer versus other popular competitors in the market. Exposures are different across the funds though, so the fund may still appeal to investors who are happy with PIMCO's approach. In conclusion, I think this fund is a high-yield-like product and can serve as a tactical allocation in a portfolio for investors who are looking for a bond product with potentially higher returns or higher yields. It may not have the highest returns versus some competitor funds, although the PIMCO branding gives some degree of comfort in the retail space. Investors, however, need to understand the risks involved with hybrid bonds before proceeding, as this is a specialized bond market segment. This concludes my absolutely biased comments on the PIMCO Capital Securities Fund. Again, if you find this video useful and would like to see more related contents, please subscribe to the channel. Thank you and have a great day.